There is an unspoken assumption in modern finance that once an enterprise reaches a certain scale of market dominance, it will perpetually compound value. Corporate boards often operate as if their organizations are exempt from the forces of entropy. This S&P 500 chart contradicts the illusion of permanence. Between 1990 and 2000, legacy industrial giants began to lose their share. In 1958, an average company remained for 61 years. By 2026, tenure compressed to less than 18. When these legacy giants vanish from the index, whether through defensive acquisitions, liquidations, or bankruptcy filings, it follows a documented structural pattern of decay. As organizations scale, they inherently cultivate the conditions for their own obsolescence. Their collapse is a predictable outcome of the very mechanisms they built to sustain their initial success. When successful companies fail, research points to active inertia. Instead of adapting, executives desperately double down on outdated playbooks. This inertia is built on 4 pillars: strategy, process, relationships, and values. Over time, these calcify into rigid liabilities, blinding leadership to disruptive threats. Blockbuster provides a clear example of a flawed strategic frame. Their leadership viewed the home entertainment market strictly through physical retail foot traffic. This perspective blinded them to the reality that consumer habits were moving permanently toward digital convenience. Kodak's demise was driven by values that hardened into dogma. Despite engineering the first digital camera in the 1970s, the company refused to jeopardize the high profit margins of its film business, allowing agile competitors to render their entire technological lead obsolete. BlackBerry's deep relationships with enterprise IT managers became shackles. By prioritizing the security and tactile requirements of government and professional clients, they ignored the global consumer shift toward glass touchscreen interfaces. Beyond these visible failures, many firms suffer from quiet failure. Risk-averse executives respond to ambiguity with silence and micromanagement, triggering a disengagement of top-tier talent long before the balance sheet reflects the damage. These dominant legacy titans do not die from a lack of capital or intellect. They fail because of a psychological inability to abandon dying markets. While some firms decay from within, others are actively dismantled by aggressive financial engineering. In 2005, a private equity consortium acquired Toys R Us in a leveraged buyout, loading the retailer with over $5 billion in debt. This debt burden stripped the company of the free cash flow required to renovate stores or compete with modern e-commerce giants, forcing liquidation. At the other end of the spectrum, the conclusion of the zero-interest rate policy era has forced a reckoning for startups. The growth-at-all-costs mentality has been replaced by a return to fundamental unit economics and cash flow sustainability. The statistical data reveals a stark dichotomy. While incumbents die clinging to the past, the apex of this concentration was OpenAI's $122 billion funding round in March 2026. This pushed the company's valuation to $852 billion, backed by Amazon, NVIDIA, SoftBank, and Microsoft. Institutional backers are funding foundational AI models as global critical infrastructure. They are treating these systems as the base utility layer of the future economy, akin to the electrical grid or the Internet Protocol Suite itself. This wealth concentration is a direct result of capital evaporating from legacy systems and rushing to build the foundational architecture of the next technological cycle. Corporate failure acts as a vital economic engine. It serves as the primary fuel for a counter-cyclical industry that creates value and jobs specifically during periods of widespread distress. The restructuring sector is dominated by elite firms like Alvarez & Marsal and Alex Partners. These specialists assume control of insolvent companies to extract and rescue the underlying assets. They implement financial discipline, renegotiate debt, and cleanse the market, ensuring resources flow toward productive sectors. This process actively liberates hoarded human talent. Skilled workers are freed from the inertia of dying legacy firms and redistributed into the high-growth fields of defense, renewable energy, and healthcare. Corporate destruction functions as the economy's primary immune response. It forces a disciplined reallocation of resources, ensuring that capital remains fluid and focused on the emerging sectors required to sustain future growth. To understand the hidden forces shaping the future of wealth before the market catches up, subscribe and stay tuned.